Hello, everyone, and welcome to our webinar. I'm Jennifer Burnett, the Director of Fiscal and Economic Development here at the Council of State Governments. We are excited to be collaborating with the Griffith Insurance Education Foundation on this webinar, which is the last in a four-part series that has taken place on Thursdays throughout the month of October. This series was designed to provide policymakers information on risk management and insurance fundamentals through the lens of critical and emerging issues. Note that we will take questions from the audience throughout the webinar. You can type in questions into the box on the side of your screen, and at different intervals in the presentation we'll stop and ask those questions of our presenter. You can also wait till the end and ask questions. This webinar will be recorded and will be available along with the PowerPoint slides on CSG's Knowledge Center starting next week. On the same website, you can find the three webinars in this series that preceded this one, and you can check those out as well. With that, I'm going to turn it over to our moderator, Frank Tomasello of the Griffith Education Foundation. Frank serves as the Program Director for Public Policymaker Education at Griffith, and he's going to provide us some background on today's speaker. Frank?
Thank you, Jennifer. The Griffith Foundation is pleased to collaborate with CSG on this webinar series examining risk management and insurance fundamentals. Our organization shares similar missions, including a commitment to a nonpartisan, non-advocative, and academic approach to programming. And it's that approach that's at the core of today's program. Our speaker for this afternoon is Professor David Russell of California State University, Northridge, where he serves as Professor of Insurance and Finance and as Director of the Center for Risk and Insurance. Professor Russell holds an AB in Economics from Amherst College and MA and PhD degrees in Insurance and Risk Management from the Wharton School at the University of Pennsylvania. To learn more about his background and research interests, we invite you to view his bio online at www.csun.edu/finance. Before we turn things over to Professor Russell, let me remind you that as webinar participants, each of you has been given complimentary access to self-paced online learning materials. Those materials coincide with the topics that will be covered this afternoon. You'll receive an email message from the Griffith Foundation. That message will contain login information and a unique username and password, which you can use to access the materials. We hope that you will refer back to those materials following the program and as needed. They're intended to serve as a complimentary resource for you. As Jennifer mentioned, we encourage your participation this afternoon. Please submit any questions you may have for the professor, and throughout we'll do our best to address those as time allows. Now, without any further ado, we welcome Professor Russell.
Thanks, Frank, and thanks to the CSG for the invitation. It's my pleasure to be here to talk to you about insurance regulation and legislation. To some people, this may not be an interesting topic, but to the people on this webinar and to me, this is a very exciting area. The insurance regulatory structure is trying to keep up with technology and developments in both the marketplace and in technology and science to develop new regulations and adapt to a changing world. So very briefly, what we're going to talk about today is insurance regulation and legislation, and we're going to talk about several pieces of that puzzle: insurance regulation and the NAIC, what regulators do, several state government insurance programs, how regulators oversee market conduct and insurer solvency, how insurance rates, you can think about that as premiums, and forms, the policies themselves, how those are regulated, how insurers are licensed and able to sell insurance. And finally, we'll talk a little bit about insurance fraud. So next. So insurance is unique in among industries in the United States in that it's not regulated at the federal level. It's almost exclusively regulated at the state level through a series of Supreme Court rulings over the last couple of centuries. Insurance was deemed to be interstate commerce, but because the states were doing such a good job, Congress reserved the right to regulate insurance to the states under the McCarran-Ferguson Act. And under Dodd-Frank, there was the development of the Federal Insurance Office. But in general, states are the ones that regulate insurance. So we have, including the District of Columbia, 51 jurisdictions overseeing insurance. And together, these jurisdictions get together, and you might think of it as an insurance congress called the NAIC. The NAIC, the National Association of Insurance Commissioners, is based in Kansas City, and they get together to discuss new ideas and ways to make insurance regulation more uniform across those 51 jurisdictions. Next. So because states have different ideas and different regulatory cultures, the NAIC tries to make it easier for smaller states or large insurers that do business across state lines to find a common framework for regulation. So there's cooperative efforts from states and the sharing of information. So together they often draft model laws and legislation and regulation for each state to pass. For example, if you have the development of ride sharing in the form of Lyft or Uber, that is something that heretofore it was not covered by regulators. So the NAIC might develop a model bill for each state to pass. So each insurance commissioner that's a member of the NAIC would take that model bill back to their respective states, and the states would consider those for passage. And in general, there is fairly uniform regulation across the states. It's not 100% uniform, as we'll discuss later, but the NAIC facilitates that process. Keep in mind the NAIC is not a regulator, but rather a gathering of regulators that share ideas, and in fact that regulatory authority still resides in the states. So why do we need regulation at all? In the United States, we have a fairly competitive market. In fact, insurance is incredibly competitive, driving profit margins fairly low. It may not feel like it to each of you when you pay your premium and don't file a claim, but in fact, insurance is not a very profitable business for most insurance companies on a percentage basis. So why have this regulation at all? Well, just like with banking or food, as a necessary service in an advanced economy, insurance lends itself to the potential for price gouging or being taken advantage of. If the state requires that you have auto insurance, then you need protection from potential abuse by insurers. Also, people don't know much about legal contracts, and that's in fact what insurance is. It's a contract. Because it's not easy for everyone to understand, we need regulators to look out for us and make sure that the contract is comprehensive, is clear, and fair to consumers. Finally, people pay their premiums up front, so the insurance company has your money at the start, and then you file your claims if you have one, hoping and expecting to be paid. Regulators are there to enforce that obligation upon insurers through their own regulatory powers as well as state courts. Next. So what do regulators do? Let's review some of the activities that regulators engage in so that we understand what can happen in the marketplace and what states can do about it. First of all, the contract is oftentimes called a policy form. So when I buy an auto insurance policy, I don't really read it. Most people put it in a desk drawer or in a file folder and don't think about it until they have a claim. Well, the people at insurance regulatory authorities in each state are reviewing these policy forms to make sure that they conform to state law and to make sure that they're clear and enforceable. If they're not fair, then the state will send it back to the insurance company for redrafting. Just to give you an example, in some states 20 years ago, it was not clear whether or not mold was a covered event in a homeowner's policy. So since in general courts interpret ambiguities in favor of the policyholders, insurance companies quickly redrafted the contract to make it very, very clear that mold was not a covered loss, and state regulators would have to approve this change. Near and dear to many people's hearts is how much they pay for insurance, whether it be for a home, an automobile, for businesses, etc. Rates have to be filed in many states with regulators and in some cases approved. That's not always the case, as we'll talk about in a few minutes. New insurance companies that want to start and do business in a state need to obtain a license. This makes sure that the people involved are not criminals, that the company has enough capital to get started, and that they meet other regulatory guidelines. Furthermore, insurance agents have to pass a test and make sure that they're not felons and committing acts of fraud and don't have a history of those acts. There's also a structure in every state for investigating policyholder complaints. If I file a claim and the insurance company sits on it for a long time, then I have the regulatory complaint structure as one of the levers I can use to try to seek relief. Finally, as we'll talk about a little later, some insurance companies run into trouble. Either they have a lot of claims or they invest their money poorly or both, and they become insolvent, unable to pay all of their claims. In those cases, insurance departments will end up seizing, just as a bank gets taken over by the FDIC, some insurance companies will be seized by their states and rehabilitated or liquidated. Next. So in the case of an insurance company that's engaging in a practice that's unlawful or ill-advised, an insurance regulator can issue a cease and desist order saying, don't sell any more insurance until we figure this situation out. This is the case for many insurance companies that face insolvency. The worst thing that an insurance company that's in trouble can do is continue to sell insurance. So the regulator can step in and say, you're no longer allowed to sell insurance until we have resolved the problem. They also engage in routine audits to make sure that an insurance company has the wherewithal to meet all of its obligations and tolerate the unexpected. So if you're doing business in Florida, you not only have to be able to pay all of your claims, but you need to have the ability to absorb several large hurricanes in 1 year. There are several different modeling agencies that offer catastrophe models and other analytical tools to make sure that insurance companies are able to meet those. Furthermore, these audits are not limited to financial pieces. Oftentimes an insurance company will be audited for its claims practices. So the regulator will come in and evaluate 1,000 different claims to make sure that the claims were handled properly and that they were settled fairly. If there's a pattern of underpayment or overpayment, then the audit will reveal that. So insurance regulators also have a financial section that evaluates whether or not an insurance company has enough money on hand to meet all of its obligations. Many of those obligations can extend well into the future. For example, an insurance company that sells workers' comp insurance may be paying for literally decades on a claim. And the question that these regulators have to test is, does this insurance company have enough money to meet all of its obligations, plus some extra that they call surplus to take on the unexpected as well? Market conduct exams can involve both the claims evaluation that I described earlier, as well as how insurance is sold. During the 1990s, life insurance was sold under, in some cases, questionable promises, and a lot of class action lawsuits were filed. So states will evaluate what kind of promises and what sorts of other advertising is made to the public to evaluate whether or not it's honest and clear and it's being sold and represented properly. Finally, at most insurance regulator websites, usually that's called the Department of Insurance. At the Department of Insurance website, there's oftentimes consumer information about what an insurance product offers. So you can find out about health insurance, homeowners insurance, auto insurance, and in some cases, there's a comparison of prices so that the savvy consumer can go online and find out more about what they're actually buying. Next. So the insurance regulatory structure is usually led by someone called an insurance commissioner, sometimes called, for example, a director, as it is in, say, Illinois, or a superintendent, as it's called in New York. These people may be elected, but more often they are appointed by the governor, and they may be ratified by the state senate. And this is oftentimes a person who has a background in business, not always insurance, but they're now sitting atop a multi-billion-dollar industry and have to oversee how that industry operates and whether or not insurance companies doing business in that state are meeting their obligations and complying with state law. Next.
David, we thank you for your comments, and we're eager to learn more about state government insurance programs in the minutes ahead, but let's take a couple of minutes to address some questions. A participant writes, can you describe some situations where regulators might take a closer look at insurance activities? And we wonder, Professor Russell, if you would take a moment or two to please address that question.
Absolutely. So most people meet the insurance industry through an agent, someone who represents an insurance company. And the agent is usually compensated with a commission. They render advice and provide policy service. And in some cases, agents are strictly interested in generating a commission. I would classify that population as a distinct minority. Most agents operate professionally, offer good advice, and earn their commission. But there are agents and bad actors in the marketplace that make promises or convince policyholders to do things that are not necessarily in their own interest, but rather in the agent's interest. This is particularly true, as I described earlier, in the life insurance business. Life insurance is a very long-term contract, and regulators have often seen situations where agents will churn a policy. They will buy, someone will buy a policy and then switch to another policy with the main intent of generating a second commission for the agent. Again, this is a distinct minority, but this seemed to be rampant in the early 1990s, and regulators came in and sanctioned a number of insurance companies and revoked the licenses of a number of agents. Changing gears quite a bit here, you may have noticed on some ads where Flo from Progressive holds up a little device and that plugs into your car and watches you with something they call Snapshot. This is more generally known as usage-based insurance or telematics. So regulators have had to try to keep up with how OnStar or Snapshot evaluate your driving from afar or evaluate your usage of insurance from afar. And regulators are trying to make sure the use of this technology is appropriate and fair and doesn't disadvantage anyone or invade someone's privacy. It's a very fine line between what's fair and what may be good public policy.
Thank you, Professor Russell. Take a moment to remind those participating in the webinar that they may submit questions. We'll do our best to address questions as they come in. Simply type your questions into the dialog box that you see on your screen. And again, as time permits, we'll raise those with Dr. Russell. At this stage, let's move to discussion of state government insurance programs.
So in some cases, the private market does not do the job that regulators would like to see them do. In some cases, the risks are not tolerable to the private market, or simply the private market has a temporary setback, and regulators feel the need for an alternative solution to solving these problems. So let's look at a few of those possibilities. So in many states, there is a state workers' comp insurance company. In many states, there are private participants, but in other states, you have both private and public. When I say public, I mean state-run workers' compensation insurance companies. That's the case here in California. In some states, you have a monopolistic carrier, as we'll talk about later. Also, unemployment insurance is a state-based program that is sort of a state and federal partnership. You have automobile insurance plans that solve some of the what we'll call market failures of the private market. We have fair access to insurance requirements, or FAIR plans, designed to provide areas that might be underserved with insurance. And finally, we'll talk about a couple of state-run pools that are oftentimes applied to high-risk areas, or high risk for wind, high risk for hurricane, or high risk for fire. So next. So workers' comp, of course, is an insurance product that in general is required by law of employers to take care of injuries that occur while on the job. So in some states like Wisconsin, you have monopolistic funds where there is a single insurance company that is not run for profit, but rather run to make sure that every employer has access to affordable workers' comp insurance. In other states, you have both a large public or state-run plan, and then you have private plans. That's the case here in California, where you have the State Compensation Insurance Fund competing with private carriers who can come and go as their market preferences dictate. And finally, in some states, you have situations where no one will insure a particular type of business, maybe because of claims history or because it's particularly risky, and there are residual market plans. This is sort of what are called the involuntary market. Since we're requiring that every business have access or have workers' comp insurance, we need to make sure that in fact it is available. Therefore, if an insurance company doesn't offer, if an employer can't get insurance from any private carrier, then there's a facility for a way that employer can get coverage from at least some source, and that's oftentimes a state source. Next. So unemployment insurance covers the risk of involuntary unemployment. So if you lose your job because of an economic situation, your employer is downsizing or there's a recession, you've got a problem. And in general, that's a problem that doesn't take too long to solve. But in the case of the Great Recession or the Great Depression, unemployment insurance will keep the economy propped up while government or the private market heals. So unemployment insurance is not privately insured because this sort of, the nature of the claims that can come in large waves, such as during the Great Recession, could bankrupt a private insurance company. Therefore, they don't take that risk. That risk is borne by the states and the federal government through the unemployment insurance program and premiums paid by employers. The benefits vary by state, and traditionally have been up to 6 months unless Congress extends the benefits. So because it's a federally supported program, there are federal standards that apply. And during the Great Recession, most of the unemployment insurance pools throughout the states ran out of money, so they ended up borrowing from the U.S. Treasury. Fortunately, as the labor market heals, there is more money coming into to these programs, and they're able to pay the Treasury back. Next. Like with workers' comp, the state requires that you have automobile insurance to demonstrate that you're financially responsible for the damage that you might do with your automobile. Some people, however, have a poor driving record or are high risk for some reason, and those people are unable to get insurance through a voluntary market. And because the state requires it, they need to make sure that they provide a mechanism for people who could not otherwise get it to get it. So usually, because one of the reasons that they're unable to get it is that the premiums are too low, these plans lose money. They're sometimes called a joint underwriting association. They might be called an assigned risk pool. They might be called the residual market or involuntary market. But what happens is people with high risks generally get insurance through one of these mechanisms, but they don't pay enough. So therefore, these plans lose money, and those costs, those losses, are spread across all insurers according to market share. So if State Farm has 20% of the market in, say, California, and the residual market plan loses $100 million, then they have to chip in 20% of that loss. Typically, not in all states, but in most states, these involuntary policies are administered by private insurance companies, so that in a way they're mainstreamed and they're accounted for as involuntary insureds. Next. And many of the same ways that the workers' comp and the involuntary automobile insurance market is administered, we have fair plans. So imagine an area of an urban area that has trouble getting insurance. Since low-income neighborhoods might have a higher crime rate, and a grocery store that's certainly a necessary service can't enter that area because they might have trouble getting insurance, and because they can't get insurance, the bank won't lend them money. The government has stepped in with fair plans which provide access to property insurance that might not otherwise be available without this subsidy. So it is subsidized by sort of a surcharge or the spreading of costs towards all other property policies. So this is not restricted to bad areas. It might also be to high-income areas. Out here in California, we have frequent wildfires, particularly with the drought. So there are areas of town or areas of the state that have fair plans to provide homeowners insurance where there's high exposure to wildfire risk. So this is, again, to prevent the private market from freezing certain buyers out of the market. And as we mentioned earlier, insurance is a very necessary service to be able to do business. If you can't get insurance, you can't borrow money. If you can't borrow money, then in many cases the real estate market or the business market breaks down. Next. So in many areas of, for example, the Gulf Coast in Texas, in Louisiana, you have beachfront or windstorm pools. There's one in South Carolina. And the whole point here is that if you live near the beach, you're exposed to hurricane risk. And because this risk can affect many policies at the same time, certain insurance companies don't want to do business there. It's too risky, therefore they don't even quote. As a result, those states have stepped in to say, well, we still want people to live near the beach. We want to protect property in that area. We want to, encourage tourism and real estate development. Therefore, we need to develop a property insurance mechanism, and oftentimes we call those beachfront or windstorm pools, and they are a way to to handle the risks that we've been describing, and in this case, they're largely driven by wind. In many cases, homeowners can get insurance for everything but wind. So homeowners insurers will insure everything but hurricane risk, and then homeowners will need to seek the coverage for extreme wind with a separate policy, a hurricane policy, and they can oftentimes do that with these beachfront or windstorm plans. Next. So in certain cases, claims or poor management or a terrible investment market can result in an insurer not having enough money to pay all of its claims. It's not that it has no money, it's that it doesn't have enough. So what do you do when the insurance company is unable to pay its claims? People have counted on that. In many cases, they've been required to buy insurance, and they're expecting that the regulators are only allowing insurance companies who are able to pay claims to sell it. So therefore, we need a mechanism, just like the FDIC for banks, that protects policyholders against an insolvent insurance company. These are called state guarantee funds, and sometimes that guarantee is spelled with a Y instead of an EE. But the whole point is that policyholders need to know that their policy is going to pay when there is a covered claim, and therefore the state administers an assessment on all the solvent insurance companies within a state. So therefore the loss is actually not borne by the taxpayers, but rather it's spread across all the other insurance companies doing business in that state according to market share.
Thank you, Professor. Let's take a moment and pose a question that we've received. A participant writes, are the taxpayers of states directly involved in taking on the risk of damage to, for example, people's homes? Could you speak to that?
Certainly. So there are taxpayer-supported mechanisms, but in general, the losses are spread across private companies or policyholders and not the taxpayers directly. For example, here in California, there is a very large state-administered plan called the California Earthquake Authority. Because few companies want to take that risk, the state, in order to keep the real estate market functioning and provide affordable earthquake insurance, they created this plan, and it does not use taxpayer money. It uses private money, it uses assessments on policies, it uses reinsurance and other ways to spread the risk and the cost to everyone but the taxpayer. So even though it's a state-administered plan, it's not the taxpayers. Shifting gears for a moment, and this is not a state plan, but rather a federal plan, the National Flood Insurance Program is backed by the U.S. Treasury. And with El Nino potentially coming, there are a lot of news outlets that are encouraging people to buy flood insurance because of the potential for flooding in the southern half of the United States over the coming 6 months. The U.S. Treasury is taking the risk of that, and traditionally the National Flood Insurance Program has lost money. And in that way, the taxpayers are on the hook for private risks written through the National Flood Insurance Program.
Thank you, Professor Russell. We look forward to your comments on market conduct and solvency regulations. We remind folks that should they have questions moving forward, please feel free to submit them and we'll address them as time permits. So, because most insurance transactions are one-on-one between an agent
and a policyholder or a policy applicant, or they're through a website, there are literally millions and millions of insurance transactions every year, and because regulators can't sit in on every transaction or every discussion, there needs to be oversight about what is said, what is done, and whether or not it meets state minimums. Again, insurance is something that people count on. It's a promise, and you need someone to make sure that the promises are kept. So let's talk about some of the market conduct areas. So we can have three main areas of market conduct. One would be the interaction between the agent and the buyer in a sales context, how insurance applications are reviewed, underwriting, is there discrimination that's fair, and finally claims handling. When someone has a claim, is it paid with fairness and in a timely way? First, let's talk about sales and underwriting. So one of the things that a regulator can do to an agent who's not representing the policy properly or overselling is they can revoke their license. They can be sanctioned. They can be fined or penalized. This is one of the levers that regulators use to make sure that agents don't overpromise or overrepresent what they're selling. In the case of underwriting, which is the evaluation of applications, insurers can lose their license or be fined for practices like redlining, which has largely been rooted from the system. But redlining is a practice that was used decades ago for insurers to avoid a certain area and say, we will not sell any policies in this area with a red line around it, literally a red area on a map. So because that is discrimination that is unfair, regulators do not permit it and will fine and expose if they can get evidence of it. They will expose this activity, and it'll be both a financial and a public relations nightmare for an insurance company. Next. So I have the good fortune of working with some professionals from a large insurance company that works across the country, and they oftentimes see claims reviews by various states. So the regulator will come in and ask to see everything. They'll ask for a conference room, and they'll literally get files out and start looking at them, looking at how claims are handled, looking at what was paid, what was the justification for this payment, how did you document this, and what in fact was the regulator's view of what should be paid. And finally, is there a systemic effort on the part of the insurance company to cheat or to underpay policyholders? And in fact, all of the professionals I've ever had the privilege of working with seem to want to pay exactly what they owe, no more and no less. But it's always good to have a watchdog to make sure that their opinion is validated by an independent party, and regulators having the powers of penalizing or revoking or sanctioning claims professionals is an excellent watchdog to maintain oversight over the claims process. Next. Finally, one of the most complicated pieces of insurance is, does an insurance company have enough money to meet all of its promises? AIG, when it was in deep trouble in September of 2008, had hundreds of billions of dollars in investments. However, regulators were concerned because they'd made even more promises than that, and ultimately they required a federal bailout. So insurer solvency is the regulation of whether or not an insurance company has enough money to meet its obligations. And so regulators don't care so much about whether or not the owners of the company make money. Rather, they care about whether or not the claims are going to get paid. So what's complicated about insurance is it's difficult to determine what those obligations might be. For example, as I described early in the webinar, someone who has a workers' comp claim may be paid out over many, many years, and you don't know what the treatment plan is or how much will be owed. For medical malpractice insurance, for an injury or a botched surgery, that may take several years to manifest itself. And so the insurance company may not, in fact, even know about the claim. Talking about in the Republican debate last night, General Motors had some faulty ignition switches. Those took several years to come to light. Insurance companies may be paying on that for many, many years, and it's difficult to forecast something that may not even be known. And that's why insurance companies need to have some extra money that is typically known as surplus to cover the unexpected. And regulators want to be sure that there's sufficient surplus to evaluate that. Next. So I've known a number of state actuaries who go in and use certain ratios to test whether or not the insurance company's financial conditions are sufficient to meet not only the expected but the unexpected. They literally stress test the balance sheets using the IRIS ratios and a number of other commonly used accounting ratios to make sure that the amount of money they have on hand and the kinds of investments they have are liquid and able to cover all of the claims as they come due. Next. So one of the ways that an insurance company is regulated is from the very start. To get into the insurance business, an insurance company oftentimes has to start with an initial amount of capital. In many states, it's $3 million. In other states, it's $7 million. So before it sells a single policy, it needs some, you could call it earnest money, but it's called initial surplus to make sure that they are able to satisfy any of the claims that come from the very first policy and any after that. So because the first few policies may have claims and the premiums may not cover those claims, there needs to be some money from the owners to maintain their ability to pay. This varies by state, and again, it has to be verified prior to issuing a license and prior to issuing the very first policy. Next. So auditors periodically review state filings that are required. Certainly the most detailed is the annual statement, and the auditors go in to evaluate whether or not, in fact, the money you say you have on hand is on hand. There are instances of fraud. They're uncommon, but they are a review of what you're doing. Let's have a look at your files. We want to see bank statements. We want to verify independently that you have what you say you have and that we believe you can meet your obligations. Next. So the NAIC has laid out for all insurance companies a specific format, and it used to be a printed document. Now it's electronically uploaded. And a number of rating agencies, as well as regulators, use these filings to validate an insurance company's solvency and ability to meet obligations and sell a new insurance. An insurance company may have stopped selling insurance, but that doesn't mean that they're not still regulated. Insurance companies have to continue to meet their obligations until the last claim is paid. Otherwise, the owners might take the money and run, and insurance regulators want to make sure that their first priority, that claims get paid, is met and is not abrogated by the misconduct or mismanagement of an insurance company. So these annual statements are used by regulators by rating agencies like AM Best and by accredited agencies and stock analysts to evaluate whether or not an insurance company is a viable business going forward. Most of us count on our insurance company, and we should and we're able to, but having the oversight and the double and triple checking minimizes, doesn't eliminate, but minimizes the risk that an insurance company won't meet its obligations. Next. So one of the complex set of ratios is called IRIS ratios, and this is a way for regulators to get an early look at deteriorating trends within an insurance company's assets or the claims data, and it is something that insurance companies manage. They realize if they're losing money, they're going to be under scrutiny, because if they're losing money, they could run out of money that would be used to cover the unexpected. And regulators require that these IRIS ratios exceed a certain level, or they'll be required to raise additional capital or stop selling insurance. Next. Finally, if an insurance company becomes so deficient in its IRIS ratios or its performance, it can be deemed to be in trouble or insolvent in some cases. And what happens is the insurance company throws out management and installs its own management and puts it in receivership or rehabilitation. It may sell it to another insurance company. Again, they're not interested in preserving value for the shareholders. They're interested in preserving the claims paying ability to meet the obligations laid out in its policies. So one of the main ways they do this is to place it into runoff or receivership. And by doing that, they stop the bleeding. They stop the insurance company from making promises they can no longer meet. And if there's a deficit, that is, there's not enough assets on hand to cover all of the claims, there'll be a state guarantee fund assessment placed on all the other insurance companies to meet these obligations. Frank?
Thank you, Professor. Take a moment to remind folks if they have questions, we encourage their participation and ask that they take a moment and simply key their questions into the panel that they have before them on their screens. One such question was sent our way just a moment ago, asking if you would, Professor, to please discuss state retaliatory tax programs as they relate to insurers.
Yes, so that's a little bit beyond the scope of this webinar, but let me say, absent from the discussion today has been a discussion of premium taxes. So a part of everyone's premiums are an excise tax, if you will, or a levy on premiums, or an addition that's used by states to raise revenue. This may be used as dedicated to insurance regulation, or it may just be used for the general fund. And because some states charge higher premium taxes than others, there can be a retaliatory tax. Sometimes states will charge a lower premium tax on states that are domiciled in that state. So an Ohio-based insurer might receive a lower tax rate than in Ohio than a California-based insurance company. And this can cause friction at the NAIC because the regulators are not always in charge of what those premium tax rates are. They're oftentimes set by the legislature. And this creates marketplace friction, and when this happens, there can be retaliatory responses to penalize the state that is favoring its own domiciled insurers.
Thank you, David. Given the time you spent discussing financial oversight by regulators, I'm wondering if you might take just a moment or two to talk about how common it might be for insurance companies to fail, as it were.
Fortunately, there aren't many insurance company failures. As you would imagine, there are two main causes. One is too many claims, and that's relatively uncommon. And the second is poor investing. Because insurance companies charge for their product up front and then wait for claims, they have very large investment portfolios. In the case of life insurance companies, this can be hundreds of billions of dollars. If they don't do a good job investing those dollars, then they may be unable to meet their obligations. This happened in the early 1990s with several large life insurance companies who invested in the junk bond market. There was a junk bond market panic, and this created the insolvency of two large insurance companies. And while they're high profile, just like AIG, they fortunately remain very uncommon.
I thank you, David. Again, we remind folks, if you have questions, please feel free to take a moment and submit them. And as time permits, we'll do what we can to pose them to Professor Russell, who will now talk to us a bit about insurance rate and form regulation.
Well, one of the things that we're all interested in is what we pay. And most of us don't read our policy, but we certainly read the front page or declaration page or the renewal, where we are quoted what it's going to cost us for the next 6 months or year. So the question that you might have is, where do those rates come from? It's ironic that yesterday in my class I had the chief actuary, the chief pricing actuary, and the rates come to some degree by forecasts and to some degree by market response. But different states have different approaches to rate regulation. Let's talk about that. So in general, the laws passed by most legislatures say that rates must be adequate. Insurers need to charge enough, but not excessive. So sort of a Goldilocks type premium, not too much and not too little. We don't want too much because that leads to consumer financial stress, and we don't want to charge too little because then insurance companies may not be able to meet their claims. And finally, not unfairly discriminatory. As a society, we've decided that certain categories of discrimination are unacceptable. In most states, however, gender discrimination is acceptable. For example, young males will pay much more than young females, and that's because the claims data simply suggests that insuring a young male is riskier. And we've decided as a society that we don't feel that that's unfairly discriminatory. Certainly it is gender discrimination, but it has a statistical basis, and we've decided it's acceptable. Next. So there are several different types of rate regulation. There's mandatory rate regulation, prior approval, file and use and file, flex rating, and open competition. I will review these generally. So prior approval or mandatory is either the rate is given and you're told what to charge, or you must apply to the regulator to make any kind of change. In some of the more consumer-oriented states, like California or New York, you have to ask for permission to change rates if those rate changes are deemed outside of a certain threshold. So California or New York make it difficult to raise rates. File and use and file allow you to go ahead and change your rates as long as you tell the insurance commissioner or the insurance office that you're going to do so. And if after the fact the insurance regulator finds that the rates you've charged were unlawful or unacceptable, they can ask you to retroactively change those rates back. But in either case, you don't have to wait for prior approval. You can go ahead and by notifying the regulator that you're going to change, you can go ahead and use that. Flex rating is some combination of asking for permission and open competition. Open competition is charge whatever you want, whenever you want. We'll let we'll keep the regulator out of it and let the market decide. Flex rating says we're going to let the market decide within a threshold. So you can change rates, but only as long as they meet a certain minimum that they don't change by, say, more than 5%. So flex rating is some sort of hybrid between prior approval and open competition. In some cases, the prior approval states can take 18 months to change rates. So it can be very difficult to change rates, and as a result, some insurance companies don't want to do business in a prior approval state. Next. So policy forms is a relatively obscure area because most people don't know what the phrases or the clauses or the paragraphs within an insurance policy actually cover. But the whole idea is that the regulator is reviewing that and looking at case law and recent rulings to make sure that these policy forms are fair, readable, enforceable, and consistent with insurance regulations. Next. As I mentioned, depending on the current state of the art in an existing state or another state, the content of form regulation is something that most people don't pay attention to because they don't read them, but there are even regulations about how many words there are in an insurance policy, trying to minimize them and trying to make it readable. Next. So there are insurance companies and insurance structures that are exempt from regulation. One of those is a surplus lines insurer, which is exempt from these regulations for the most part. And these are for unique or hard to place risks, such as a mansion in a wildfire area that all other insurance companies decline. They say your risk is too large, it's in too risky of an area, we don't want to take that. Our policy system won't take a 9-digit or 8-digit risk in our policy system. Therefore, you need to make specific arrangements. Lloyd's is a place where many surplus lines or unique or hard to place risks end up, and they're exempt from rate and form regulation for the most part. Next. So, insurance licensing is one of the ways that regulators can control who does business within a state. So, I'm going to go very quickly given the lateness of the hour, but in general, a domestic insurer is an insurer that is licensed and domiciled in the area. A foreign insurer might be licensed but not domiciled in the area, and an alien insurer may not be licensed or domiciled in the area. And in this respect, you have different types of regulations and premium taxes, as I described earlier, that would control this, and there might be reasons to stay outside of its jurisdiction if you want to avoid the regulation of that. Next. So very quickly, the two main types of insurer ownership form are stocks and mutuals. Most insurance companies in the United States are stock companies. They're owned by shareholders, and the shareholders elect a board of directors who oversees management. Mutual insurers are less common, but they're also the largest. State Farm Mutual Automobile, Nationwide, these are mutual companies. An example of a stock company is Allstate or Metropolitan Life, MetLife. A mutual company is like a co-op. It's owned by its customers. You might think credit union in the same light. They also elect boards of directors, and the boards of directors oversee management. The difference is that the boards of directors are elected by the customers, the policyholders, and most policyholders of a mutual company don't know that they're owners because they can't sell it. A reciprocal is a relatively uncommon type of arrangement where it's similar to a mutual, only it has a management company. The largest in the United States is Farmers, which they are a reciprocal, but their management company is owned by Zurich. Next. So admitted and non-admitted insurers, most insurance companies do business in a state as an admitted insurer. They're licensed in that state and they do business in that state. A non-admitted insurer is someone who's not licensed in the state, but they can still do business there as a surplus lines insurer. When all of the admitted insurance companies turn down an applicant for insurance, then the applicant can go through their agent or broker to a non-admitted insurer. It's sort of, you might think of it as a gray market. It's certainly regulated and very healthy, but in general, risks are first required to go to the admitted market to seek insurance before they're allowed to go to a non-admitted carrier. Next. So as I mentioned, surplus lines insurance is for interesting or high risk, the placement of insurance through generally non-admitted insurers. Next. So licensing. As I mentioned, agents and brokers and claims representatives in some states must pass an exam and get a license. Otherwise, they're not allowed to do business. And this is one of the areas where regulators can root out, bad actors by revoking their license. So licensing is one way that they can control who and how insurance is conducted in a state. Next. Let's talk briefly about fraud next. So insurance fraud is an $80 billion a year business, and the average household pays between $500 and $1,000 more in insurance premiums because of fraud. It is a white-collar crime in that, in general, it's on paper. The participants may not even see each other, and some people even believe it's a victimless crime. Clearly it's not, but it's expected that of your auto insurance premium, about 10% and 10% of your homeowner's premium is attributable to fraud or padded claims. Next. So where does the fraud come from? Well, staged claims, that is events that never happened or they really shouldn't have happened. They were done, these accidents occurred solely for the production of a claim. There is opportunistic fraud, that is people who have a deductible, for example, a $500 deductible, and they want to pad their claim because they're upset that they're going to have to pay $500 of the loss. And finally, some people will say, my car's not garaged in this high-risk area, it's garaged somewhere else, using a fraudulent zip code. They get insurance, and they're paying a lower rate than they otherwise would. Next. So attitudes vary across time in terms of whether or not padding is okay or whether or not somehow you deserve more money because you feel like you're going to get your money back from a claim. I would say that insurance fraud is more often an opportunistic event, that people are upset that they've lost, they haven't recovered as much as they want, or they were underinsured for certain things, so they inflate a claim to make up for that. And attitudes clearly range between about 25% of the population and up to 40% think it's okay to engage in this. Next. And it appears that younger males are the most likely to feel that it's okay to engage in insurance claim padding. Next. So the federal government has sort of more general fraud laws that would influence in the prosecution of insurance fraud, but more often it's state laws. Next. So there are reporting statutes and immunity statutes. Most state regulators require that insurance companies engage in insurance fraud prevention, because insurance fraud protects everyone. And as an insurance fraud expert told me recently, oftentimes insurance fraud is tied to other types of organized crime, drugs, prostitution, human trafficking. And in these cases, we're not talking about claims padding. We're talking about staging claims and having organized rings of doctors and lawyers, etc. But in general, the participants in rooting out this fraud are given immunity, and they're required to report it in certain cases when they have evidence that it's happened. Next. So in summary today, and again, I thank you for your patience for sticking around, we talked about how the states and not the federal government regulate insurance. And through the NAIC, there's some uniformity across states in rates, policy forms, the oversight of market conduct, and reviewing insurer financials to make sure that these insurance companies are up to the task of meeting their promises. Finally, licensing both insurance companies and professionals is a way that the regulatory authorities make sure that both the people involved and the companies are up to the task of not only financially meeting, but their morality and their legal standards are high enough that the people involved can be counted upon to meet this very fundamental need in an organized economy. So I see on my chat screen there, Frank, something about risk-based capital. I'll give a very brief overview of that. Risk-based capital is a set of insurance regulatory ratios that determine how much capital or surplus an insurance company has to have on hand to back the promises it makes. So the riskier the type of insurance an insurance company sells, the more capital they're going to have on hand, because the more likelihood there is that there's a large claim or an unexpected event. So earthquake would have very high capital standards. Another place that risk-based capital would come in is on the asset side. So if I have a U.S. government bond, the risk of holding that bond and having it lose value is much lower than if I own common stocks. So the risk-based capital structure is a set of ratios that gives credit and penalizes the low and high risk activities and investments that an insurance company engages in. And using this set of ratios, the insurance company and the regulators can manage the risk, the overall portfolio that they have of risk, both in the types of risks they take on as an insurance company and the type of investments they make. Through this set of ratios, they're able to dial back the risk. The NAIC came up with this in response to those insurance company failures of the late 80s and early 90s.
Thank you, David. Appreciate your addressing that question, and we greatly appreciate your comments and insights this afternoon as well. We thank all of those out there for their participation today, and want to take a moment again to remind folks that they'll have complimentary access to self-paced learning materials, those materials dovetailing with the topics that you've covered this afternoon. If you've not already, as participants, please look in your inbox over the next day or so for information from the Griffith Foundation that'll contain username, password, login information that'll allow you to access those materials, and we encourage that you do so. Again, Professor Russell, thank you very much.
Thank you, and I encourage any participants who have additional questions, if they feel so compelled, to reach out directly. You can find me on my contact information on the internet. And again, I thank the CSG and the Griffith Foundation for running these seminars. I think they're very valuable.
Great. Thank you, Frank, and thank you, Professor Russell. That concludes our webinar for today. I'd like to remind everybody that you can watch a recording of this webinar on our website. It will be posted by early next week. You can also get a copy of all the slides, which will have contact information for Professor Russell if you have any follow-up questions. With that, I hope everybody has a good Thursday, and hope to see everyone back in a webinar series in the future. Thanks so much.